I'm Alex Gault, Senior Investment Analyst at Retirement Plan Advisors. Today, I'll walk through market performance for the first quarter of 2026 and share our forward-looking views as we move through the rest of the year. We hope you find the discussion helpful and informative. After a strong January, financial markets were negatively impacted by the U.S.-Israel military campaign against Iran at the end of February, leading to broad unease across asset classes. Crude oil prices surged over 60% during March due to Iran closing the Strait of Hormuz, through which roughly 20% of global oil flows. A prolonged spike in oil and gas prices negatively affects consumers who are already paying more at the pump, and it could spill over into other areas such as groceries. After 3 straight years of double-digit gains for the S&P 500, the first quarter reminded us that markets don't always move in a straight line. The S&P declined 4.3% for the quarter, with virtually all of the downside occurring in March. Notably, international stocks actually continued their recent outperformance, with developed international equities down only around 1% and emerging market stocks finishing the quarter flat. Fixed income markets fared much better than equities during the quarter, with core bonds ending flat and high-yield bonds down roughly 50 basis points. Treasury yields rose sharply in late March as inflation expectations climbed, with the 10-year Treasury yield reaching 4.3% by quarter end. This rise in long-term yields, coupled with the oil shock, suggests some inflation jitters may still be affecting the markets. That said, we believe bonds remain an important source of both income and portfolio diversification, particularly as equity markets are facing elevated uncertainty. The tensions in the Middle East occur against a backdrop of softening but still decent macroeconomic data, painting a mixed picture for the rest of the year. GDP growth is forecast to moderate after a solid 2025, but the decrease in inflation has stalled and the labor market has weakened a bit. The Fed held rates steady at 3.5% to 3.75% at both its January and March meetings, and they're continuing to project just one rate cut this year. Looking ahead, there are meaningful crosscurrents to navigate. On the positive side, corporate earnings growth is expected to remain solid, with analysts projecting double-digit growth for the full year. Broader earnings participation beyond mega-cap technology names continues to be a healthy development. It's also worth noting that last year, the S&P declined about 4.6% in the first quarter before rallying 22% over the final 9 months. A tough start doesn't always define the year. We continue to believe that a well-diversified portfolio, one that includes international stocks, fixed income, and exposure beyond the largest U.S. tech stocks, is the best way to navigate this environment. Thanks for tuning in to our market commentary. From all of us at RPA, we wish you a wonderful spring season ahead. And remember, the future is better than you think.